Soothing words today from Janet Yellen, of course, the new chair of the Federal Reserve, who testified today before the Senate Banking Committee about the strength of the U.S. economy right now. And that helped investors send the S&P 500 index to a new record closing high today. Ms. Yellen told lawmakers and Wall Street that she is staying the course right now. She will continue to taper back on the central bank's asset buying stimulus program and keep record low interest rates right where they are. But she's also keeping an eye on whether the winter unrelenting snow and bitterly cold temperatures have been responsible for the slowdown in job growth and consumer spending that we've seen, or if they're indicative of a larger long-term problem in the economy. And the new Fed chair is cautious in her long-term forecast for the economy. Steve Leisman has more on Ms. Yellen's appearance on Capitol Hill today, what she said that Wall Street liked, and where she sees the economy heading next.
The new Fed chair in testimony before the Senate today gave her long-run outlook for the U.S. economy, and it wasn't a pretty one. Asked how long it would take for the economy to normalize, Janet Yellen ventured a disheartening several years, I think. She reiterated the bleak outlook for Americans who are looking for full-time jobs.
The fact that we've seen very slow growth in wages, for example, I take as one of many pieces of information suggesting that the labor market has not returned to normal and has quite a ways to go. And it's something that's appropriate for us to look at as we consider appropriate monetary policy.
On the immediate economic news, Yellen suggested that a lot of recent weakness in the data is likely the result of weather, but the Fed hasn't figured out yet how much.
In the weeks and months ahead, my colleagues and I will be attentive to signals that indicate whether the recovery is progressing in line with our earlier expectations.
Yellen is sticking to the general policy of her predecessor, Ben Bernanke. Because the economy has improved somewhat, the Fed is reducing its bond purchases meant to drive down interest rates and is on track to wind them down by the end of the year, unless there is, in Yellen's words, a, quote, significant change in the outlook. But because the economy is still operating below normal, the Fed plans to keep interest rates very low for a long time. For Nightly Business Report, I'm Steve Leisman.